Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our January monthly market update. Before we begin, we want to thank our value clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. So we'll get started. We hope that many of you will be joining us here in just a couple of weeks at our quarterly investment forum at Perry's over lunch. If you haven't RSVP'd already, please do so. We're getting near capacity, so we hope to see many of you there. So 16 years ago today, January 9th, Steve Jobs unveiled the iPhone. He said, among other things, that it would be a futuristic design, multi-touch display, no physical keyboard, an iPhone OS, a proper mobile operating system. Now, the response wasn't overwhelmingly positive. This is a quote from 2007. I'm more convinced than ever that after an initial frenzy of publicity and sales to early adopters, iPhone sales will be unspectacular. iPhone may well become Apple's next Newton, says this writer from February of 2007. Through 2018, only 2.2 billion iPhones have been sold. So speaking of Apple, this is kind of what happened to technology stocks 2020, 21, and then last year. So after fantastic years in, for example, with Apple in 2020, 21, a major decline. In fact, Apple of these 5 mega cap stocks were the best, with Meta and or Facebook being down 2/3 in 2022. So we've talked about this before, just worth revisiting, especially with the backdrop of 22 behind us, that at the beginning of 2022, when markets were high, you were at the place of maximum financial risk, and yet you felt the best. Here we sit after market declines in 2022, likely somewhere in this range, which ironically, you're in the place of maximum financial opportunity, but you're also in the place where, from a sentiment perspective, you're feeling the worst. So a lot of busyness here, but this is just kind of the S&P 500 on a line chart with all of the items that the S&P was consuming, and we'll unpack a few of those today. It started the year with the highest inflation print since 1982, kind of ended the year with FTX founder being arrested. And this is kind of a line chart as the S&P went from 4850, about where we began the year, to about 3,900 when we ended the year. The 10-year also moved around a lot. We started on the 10-year at just about 165, finished at about 3.8, but went to a high of about 4.2. And part of what was included there is that on 1028, mortgage rates hit a 20-year high. So pretty overwhelming losses in 2022 in most asset classes. You'll see 105 out of 112 asset classes lost money, which is unusually high. Everything kind of got correlated to a 1 as an example. This is a line chart again of the S&P 500 where we started the year versus where we ended it. You will see that we did have a pretty significant move in Q4 to the upside, but overall we were down roughly 20%, although at the low point we were down 25. So some improvement off of the lows due to the last quarter of 2022, but still significantly down. So what's been top of mind in markets all year is kind of the Fed and inflation, in part putting out a fire that they helped create. So this is a line chart of kind of where inflation has been over 22, with the last reading at 7. So 9 at this point has been peak inflation. Now inflation remains stubbornly high, but we're off peak, which is relevant because as we look at financial markets, kind of knowing whether or not we hit peak inflation is important. This is other periods of time where you have peak inflation and what the market looks like the next 12 months. So on average, over other peak inflationary periods of time, if we can call June's 9/1 peak, on average, stocks and bonds up 21 and 7% respectively over the next 12 months. So the Fed was busy, again, ditching the term transitory for inflation. The Fed raised rates several times, including 475 basis points increases in a row, moderated slightly in December by only 50 basis points. Now, this is a busy chart, but it kind of shows you what the Fed fund futures are saying in terms of what's likely to continue to happen year-wise and in terms of peak interest rate increases. And the point of kind of mentioning this graph is to say that we're closer to the end than the beginning in terms of rate increases in the market digesting that. And this is why that's relevant. If we look at returns, stocks and bonds following the last interest rate increase, you'll see over the next 12 months, on average, stocks and bonds up both double digits, with stocks up just under 20 and bonds up 11.5. Now, again, the Fed will still have more work to do in 2023, likely continuing to raise rates, but we're closer to the end than the beginning in terms of how much the Fed is going to raise rates. The December jobs report was a pretty good one, although not that hot. So it was kind of a perfect jobs number that the market responded favorably to. Unemployment dipping down to 3.5, new jobs created 223, and average hourly pay up 4.5 year over year. There's still a stubbornly high job openings number. So this again from October of 22, 1.7 job openings for every applicant. So as we turn the page to 2023, let's talk about recession. On average, about 2/3 of economists believe that we will go through a recession in 2023. The question is when, how severe, and how much of that is the market already priced in, with the S&P down 20% in 2022 and the NASDAQ being down roughly 30%. So this is a look at quarter-over-quarter GDP in 2022, ending with 3.2 in Q4. Again, we're in a consumption-driven economy, so 70% of the economy is driven by how the consumer is faring. We have seen debt service pick up a bit, and we have seen the excess savings that was kind of accumulated during COVID start to burn off. In fact, this data point that we've shared with you before anticipates that this excess savings that had accumulated during COVID is likely burned off by middle of this year. So let's say that we do go into a recession. One of the questions is, again, when, how deep, and how much is already priced in. This is a look at what happens during markets since 1929, 3 months before, during, 1 and 3 years after. So kind of what this indicates is that most of the market moves happen well in advance of the recession. So that 3 months before and even during, markets are slightly positive, and then 1 and 3 years after, on average, much better. And then this just looks at historical kind of expansion versus contraction. On average, we spend an expansion about 5 years, and on average, recessions last about 12 months. We did recently rebalance the last week of December. Part of those themes, we went through this in detail, but we kept our cash overweight, continued to have an overweight to energy, reduced our already light international footprint. We'll continue to rebalance in the new year as we think there's opportunities to do that. So please let us know if you have any questions about that at all. None of this is a substitute for contacting us directly to ask how all of these things impact you. So we encourage you to leave no question unanswered. Please reach out to us. We're here to serve. So with that in mind, we'll close. We wish you and your families a very happy new year. We hope you enjoyed your holidays. And please reach out to us if you have any questions. We hope to see many of you in just a couple of weeks at our quarterly investment forum at Perry's. Until we see you again, be well. Take care.